What if I told you the money sitting in your bank account right now might actually be making you poor every single day? Hi, I'm David, and in today's video, we're going to break down why keeping too much cash in the bank is one of the most dangerous mistakes you can make with your money. I'll show you how inflation quietly eats away at your savings, the exact size your emergency fund should be, and most importantly, where you should actually be putting your money so it grows instead of sitting idle. Most people think a bigger bank balance means they're being smart with money, but the truth is cash is the laziest worker you'll ever hire. And you grind hard to earn $10,000 and then you let it sit in an account doing absolutely nothing. A year later, it hasn't made you a cent, and because of inflation, it's worth less than when you earned it. Stick with me until the end because I'm going to give you a clear step-by-step way to stop letting your money be lazy and instead make it work as hard as you do. So here's the problem with keeping too much money in your bank account. It feels safe, but in reality, it's shrinking every single year. Think about it like this. Your cash is the laziest employee you'll ever hire. You put in the long hours, the overtime, the stress, maybe even missed family time just to bring home that paycheck. Let's say you manage to save $10,000 and park it in your savings account. You go back a year later and guess what? That money has done nothing. It hasn't grown, it hasn't multiplied, it's just been lying around collecting dust. Now add inflation to the mix. Inflation is like a silent thief. It means the same $10,000 buys you less than it did the year before. So while you're working harder, your money is working 0 hours. Over 10 years, the value of that cash could drop so much that you're basically losing thousands just by leaving it there. But here's the thing. You do need some cash in the bank. Now, not all of it, but a specific amount for emergencies. And this is where most people get it wrong. They either keep way too much sitting there because it feels safe, or they don't keep enough and end up panicking when something unexpected happens. So how much do you really need? That's where the emergency fund rule comes in. It's simple. Take your essential monthly expenses. I'm talking rent or mortgage, groceries, basic bills, transportation, and minimum debt payments. Multiply that number by 3 if you want a basic cushion. Multiply by 6 if you want more security. And if you're self-employed or your job is unstable, aim for 9 months worth. For example, if your core living costs are $2,000 per month, a solid emergency fund would be between $6,000 and $12,000. That's all you really need to have liquid and accessible. Anything beyond that, that's not an emergency fund, it's fear money. And fear money just sits there losing value every single day while tricking you into thinking you're being smart. I've seen people with $40,000, $50,000, even $70,000 sitting in their accounts calling it their emergency fund. But when we actually broke down their real monthly needs, they only needed half of that. The rest was just wasted potential. So yes, keep an emergency fund, keep it in a high interest savings account that's easy to access. But beyond that, you're better off putting your money to work somewhere it can actually grow instead of letting it be lazy in your account. Now let's talk about one of the sneakiest dangers of keeping too much money in your bank account. How it actually tricks you into spending more. Think about the last time you logged into your account and saw a bigger balance than usual. Maybe you got a bonus, maybe you've been saving hard, or maybe you just let money pile up without moving it anywhere. What happens? Your brain goes, oh, I'm good. I've got money to spare. Suddenly, dinner out feels more reasonable. That new phone upgrade doesn't seem like such a bad idea. You might even book that weekend trip because you still see plenty left in your account. Here's the problem. Most of that money isn't actually spending money. It might be your emergency fund. It might be the start of a house deposit. It might just be cash you haven't directed yet. But because it's all sitting in one big pile, your brain labels it as available. And that's how lifestyle creep starts. I'll be real with you. I made this mistake myself. I had a period where all my income was flowing into one account, and because I didn't have my automation set up, I started spending more without realizing it. It wasn't big things, just extra meals out and little impulse buys, stuff I normally wouldn't do. But over a few months, those small decisions added up. When I looked back, I realized I had been eating into money that was meant for investing. The simple fix, I went back to automating my system. Money goes straight into investments, savings, and bills before I even see it. Out of sight, out of mind. So here's the takeaway. If you want to stop yourself from overspending, don't leave all your money sitting in one visible account. Set up automatic transfers so your emergency fund, investments, and savings are separated the moment your paycheck comes in. That way, the number you see when you log in is your actual spending money, not the pile that's supposed to be working for your future. But overspending isn't the only danger. There's another risk most people never even think about: bank insurance limits. Here's what I mean. Every bank has a cap on how much of your money is protected if that bank fails. In the US, the FDIC protects up to $250,000 per depositor per bank. In the UK, the FSCS protects up to £85,000 per person per bank. Sounds like a lot, right? But here's the catch. Anything you hold beyond that amount is technically at risk if something ever went wrong. Now, if you're not close to those numbers, you might think this doesn't apply to you. But the bigger issue is why you're letting that much money sit in cash in the first place. If you're saving for a near-term goal like a house deposit, a wedding, or a new car, then fine. You'll want to keep that money safe in cash. But here's the golden rule. If you don't need the money in the next 5 years, it shouldn't be sitting in your savings account. Why? Because the stock market can be unpredictable in the short term. You don't want to risk your house deposit shrinking by $5,000 just because the market dipped right before you needed it. But for money you won't need for several years, the long-term growth from investing far outweighs the false security of cash. So here's the system. Emergency fund. Keep it in cash, easy access, high interest, short-term goals, under 5 years. Also in cash, but spread across banks if you're near insurance limits, long-term wealth. Get it invested so inflation isn't quietly draining its value year after year. And this brings us to another hidden risk that no one likes to admit. When you have too much sitting in cash, you don't just risk inflation and overspending, you actually make yourself a target. The last danger of keeping too much cash in your bank account, it doesn't just make you lose money to inflation or spend more than you should, it can also make you a target. Think about it. When people know, or even just think, you're sitting on a big pile of cash, you instantly become more attractive to scammers. Maybe it's that once in a lifetime business deal. Maybe it's a family member or friend who suddenly has an emergency and needs to borrow. Or maybe it's a random message about a guaranteed investment that promises to double your money in a few months. The truth is, scammers don't need you to be gullible. They just need you to have idle money sitting around waiting to be taken. Even beyond scams, having excess cash lying in your account means you're not being intentional, and unintentional money is always at risk. It leaks out in small purchases, bad decisions, or simply losing buying power year after year. So the question becomes, what should you actually do with your money once you've built your emergency fund and covered short-term goals? Here's a simple 3-step action plan that anyone can follow. Step 1, lock down your emergency fund. Keep 3 to 6 months of essential expenses in a high-yield savings account. This is your safety net, nothing more. Don't touch it unless it's a true emergency. Step 2, automate your investments. The second your paycheck comes in, set up automatic transfers into your investment accounts. Whether it's an index fund or retirement accounts like a 401k or IRE, make sure your money is moving toward assets that grow over time. If you don't automate, your brain will always find excuses to spend first and invest later. Step 3, funnel cash into purpose. Every dollar beyond your emergency fund should have a job. If it's for a house, put it in a separate high yield account labeled house fund. If it's for retirement, it goes straight into your investment account. If it's for a business, keep it in a business specific account. When money has no purpose, it leaks. When it has a clear job, it grows. And here's the mindset shift I want you to leave with. Cash in the bank feels good, but wealth is not built by looking rich in your checking account. It's built by putting your money to work behind the scenes where it grows while you sleep. So don't let your money be lazy. Don't let inflation steal from you. Don't let your hard work sit idle, because the moment you give your money a purpose, the moment you direct it into assets that compound over time, that's when you stop working for money and your money starts working for you. If this video helped you rethink how you handle your cash, make sure to subscribe, because we talk about money, investing, and building real wealth every single week. And remember, lazy money is lost money. Smart money builds freedom.